But not only that, this is actually what I wanted to mention prior to even just the 930 high and whatnot. This is actually optimal trade entry right here, right? So if we're going to expect a reversal, we're going to expect a reversal at optimal trade entry of the dealing range, right? So this is the current dealing range from this high to this low, right? Price is being dealt within this range. So obviously if we're going to see a reversal, we're going to take that same dealing range and we're going to look for optimal trade entry. If, you missed out on the move higher, you're going to seek optimal trade entry off the bearish dealing range, which in this case is right here, right? So I personally like to look at the 0.705, which is your golden ratio, which is what ICT talks about. If you're going to be looking for optimal trade entry, it's going to be the 0.705, which is, I mean, as we can see here, a perfect example where price actually reversed there. And how can we, I haven't annotated this, so actually we're going to be annotating this in real time, but how can we actually capitalize off of this right here? So when price taps into optimal trade entry, usually we anticipate a reversal off the 0.62, which is right away. And I've seen this only work on higher time frame, like 15-minute, 1 hour, 4 hour charts. Lower time frame, which is 1 to the 5 minute, price likes to dig deeper into the 0.705, into the 0.79, seeking, maybe manipulation, stop rate, whatever the case may be. But 0.705 usually is the one that holds. So, I mean, we can see the model set up right here perfectly. I mean, we have a liquidity sweep, right? Do we have an imbalance on the liquidity sweep leg? Yes, we do, right? Now, this imbalance on its own isn't, what did we just talk about, right? So the close below is a pretty shitty fill, unless you're just targeting low-hanging fruit right here. Yeah, you can enter on the close and then just target low-hanging fruit there. But if you want to catch the meaty part of the move, then you're going to want to wait for the imbalance to be formed, right? So we have the inverse, and then after the inverse is formed, then we have our imbalance. And then what is formed when we overlap the imbalance and the inverse, right? We have a BPR now, right? Which would be, let me turn on my magnet, which would be right here, right? So we have a BPR formed right there, and we have a BISI overlapping with an inverse, which is actually where price retraces right there, and it actually retraces back into the 0.62, offering lower. Where would we target? This is when we would pull up our standard deviations, and we would want to target lower. You can do wick to body, wick to wick. I just prefer wick to wick. You catch a little bit more of the move like this. But this was another entry. If you were bearish, you have a BISI in line with an inverse. So we have the inverse right here, right? If we get rid of the inverse and we only look at the BISI, we have the BISI. If we combine both of them together, then we have the BPR. And that's actually where price seeks fair value, distributes lower, and eventually reverses here after sweeping weekly low. And even on this end of day, I'm pretty sure there was a model right here too. We anticipate a reversal here, price sweeps the low. What do we do now? We look for an imbalance, right? We close above a 5 minute, but that's not your entry. Your entry is the retracement. Oh, perfect, right here into the 5 minute. Do we tap into that? We do. We tapped into it right here. So we actually tapped into the BPR here. So now this is a BPR because it's overlapping, right? Now that we have the BPR, how do we find a model of this? I mean, you could just do a 1 minute model here where price would close above, or you can do change in state of delivery too. I mean, you could use this order block alone, right? So price sweeps lower, taps into the 5 minute BPR, changes in state of delivery, price books back into it, forming also just a little mini breaker here. Where is it? Right there. We can actually push this out in time. And then assuming this was the low, price reaccumulates 1 to the 1.5. This would be the reaccumulation, right? So what does price do? Reaccumulates, taps into the breaker one more time, redistributes back up to, which would be the PM session high up here. So the models are everywhere. It's just all about finding the context and the narrative. What I like to do is, so let's say we're on the 1 minute, right? and we're looking at the same exact imbalance. How do we take a model off of this? Now, if you're really eager to enter on the 1 minute and you want to like be aggressive, then take the swing high to the swing low that you assume is going to be the manipulation leg, which in hindsight, obviously it is. This was the manipulation. Take premium discount. All right. Now, what does premium discount tell us? It tells us the price where price will reverse, right? So if this imbalance right here, this bullish imbalance is in premium and price closes above this imbalance, so this is a SIBI, right? And it's in premium, we would expect price to dip lower, right? We would expect price to do this, right? But what is price telling us? It's telling us a story, right? It's telling us that if we're closing above a bearish imbalance in premium where we would expect price to reverse at, that's a market structure shift, right? Obviously, the change in state of delivery doesn't occur up until here when we close above this order block, but we're just looking for market structure shifts. There's a difference between a market structure shift and a change in the state of delivery. So for now, if you want to get the early entry and you want to be aggressive on the 1 minute, go ahead, trade at the 1 minute, but look for premium discount. What I do is I like to look at, so we look at the manipulation leg, right? But I like to look at how many imbalances are on the manipulation leg. On this leg, we have two, right? We have two 1 minute imbalances. We have the one above and the one below. On the 2 minute, okay, here we go. Actually, no, we still have two. The 2 minute has this one up here, this tiny little one up here. And for my taste, this is a little bit too tricky because now the close above is here, and the BISI's all the way down here, so it doesn't line up as much as you would want it to, right? So we go to the 5 minute. I mean the 3 minute. The 3 minute. Okay, look, the 3 minute actually has one imbalance on liquidity sweep leg. Now we already looked to the left. We have our inverse, right? And the close above is right here. You could do the close above if you want to, but the higher probability entry is when price retraces into the BISI and it forms that BPR right here, right? So the BPR would actually be right here. We have the BPR, and this is actually where it holds. So the 3 minute was also a potential candidate for an entry time frame. Right here, right here. That's when price taps into the BPR. So maybe you didn't want to do the 5 minute, maybe you wanted to do the 3 minute. The 3 minute and the 5 minute both have one imbalance on the liquidity sweep leg. 3 minute as well, right here. Actually, it didn't. I just realized that. The 3 minute had one below right here. But the reason I chose the one above is because it's obviously in premium, and it's because it lines up with the imbalance right here to form a BPR. But if you want a singular fair value gap to make it super simple, then yeah, the 5 minute would be your best bet. Do we have an imbalance on liquidity sweep leg? Yes, we do. We have two. So let's say you were forced to take it on the 1 minute. Then you would take premium discount on the leg. Price imbalance in premium being disrespected. Yes, it was, right? It was disrespected there. That's not your entry. Your entry is when price taps into the fair value gap. That's why it's called fair value. That's why it's called a fair value gap, because it's offering fair value. Price taps into it there. You can see a tiny little BPR there where price overlaps with the inverse and the BISI right there. So there's your BPR right here. This would be your entry, standard deviations. Actually, you could just use this, standard deviations, wick to wick. Oh, actually, I pulled that the wrong way. From low to high. There you go. Targeting standard deviations, right? So you can target the first standard deviation, which is where you would expect price to retrace or reverse. Target it right there, or you could target the second standard deviation right here. There, that would be your target. Or I mean, if you have runners, you can even just target the 3.5 to the 4. It should be right here.